In this lesson, we're going to start with a few ideas that I'll expand later in this course. The Forex market transacts $5.3 trillion a day, and this is often used to justify that it can't be manipulated. But is this really true? You see, the market is all about liquidity. Liquidity is where the money is, and the market is on a constant mission to find it. It turns out liquidity are actually yours and other traders' stop losses. And this provides a fuel for the smart money to enter the markets. This occurs via manipulation and misdirection. So who manipulates the Forex markets? Well, there's the central banks, such as the Federal Reserve, the Swiss National Bank, the European Central Bank and Bank of Japan. And then there's the investment banks, such as Goldman Sachs, JP Morgan, UBS, Deutsche Bank, and many more. So who are the targets of this manipulation? Well, there's the bank's clients, as we'll see later, corporations, hedge funds, and large traders. Incidentally, retail traders only make up 5% of the market, of which 50% of those are filled internally by their broker and never go to a real market. So why is the market manipulated? Well, smart money is quite literally the elephant in the room. Entering the market in the wrong way will cause the price to move against them. So by becoming counterparty to the less informed traders' stop losses who are exiting the market, they obtain liquidity to enter the market in the opposite direction. And there's more. In order for the smart money to enter the market using your stop loss, they need to persuade you to put it in a place that's beneficial to them. And this is what we call engineering liquidity. But we'll cover this later in the course. Is my broker out to get me? A common misconception among retail traders is that their brokers are hunting their stops, whereas the truth is that most traders put their stops in the same place. However, individual brokers do not move the markets. That is the job of the banks and the central banks. That is not to say less scrupulous brokers won't play tricks by widening the spread, delaying execution, platform freezes, and slipping your stop loss more than necessary. But generally, retail brokers cannot move the real Forex markets. Let's look at one example of manipulation in the Forex market investigated by the Financial Conduct Authority. The FCA found HSBC, your favourite local bank, guilty of manipulating the Forex markets. They were fined $216,363,000. In an excerpt from the FCA's document, we see HSBC attempted to trigger client stop losses for HSBC's own benefit and to the detriment of their clients. Yes, that's you and me. In another case, banks' senior traders formed chat rooms to discuss clients' trades and collude to manipulate currencies and fixed rates. These chat rooms had such salubrious names as the Cartel, the Bandits Club, the Mafia, One Team, One Dream, and the big investment banks we've come to know and love were all involved. And that's only the tip of the iceberg. Manipulation occurs on a daily basis, not just in Forex but in every financial market in the world. The good news is we can turn the manipulation on its head and profit when we see it. But this course isn't just about stop hunts. It's about identifying the elephant footprint trail that the smart money leaves behind and recognizing the patterns when they enter the market.